We are also seeing the VIX, the volatility index, spiking, currently above 27 and rising near the year-to-date high that we saw last month. Our next guest saying to expect continued and increased volatility to come. Here with us, we've got Liz Ann Saunders, Chief Investment Strategist over at Charles Schwab. Liz Ann, great to have you this morning. What are you thinking? Where do we go from here?
So I think what the market was pricing in with a 10% correction was maybe something around the base case. And there have been a lot of best case, base case, worst case scenarios trotted out in the last several weeks. And what we ultimately got was worse than the worst case. And I think there's many facets to it. I think the lack yet of clarity on how does one negotiate this, given the somewhat simplistic methodology around coming up with these tariffs rates, where everybody's trying to figure out, all right, so what has to happen for those to come down? And there's not much clarity on that. I think another important facet to all of this that is less discussed as we look at what likely will be many firms and economists raising their probabilities of recession, I think it's well better than an even odds at this point, is the tentacles from the equity market to the economy. We have household exposure to equities at an all-time high. It's risen for every single income bracket. And it makes me think of the 2001 era where we had an economic recession that probably wouldn't have been one were it not for the weakness in the equity market. So I think we have to put an increased amount of weight on what the market does, not just for things like will it trigger the Fed to do something, but what are the actual implications for the economy? And that's additive to the downside.
And also, we are seeing that the U.S. 10-year is falling below 4% this morning for the first time since October, just since we started asking you questions here, Liz Ann. What is the bond market telling you about the health of our economy and about the amount of power that the Fed has to control this economy moving forward?
Well, in general, when bond yields are keying off the growth trajectory and prospects thereof and move down, you tend to see a positive correlation with equity. So lower bond yields, lower stock prices when the bond market is keying off growth. If the bond market were keying off inflation and we saw the move down without a commensurate hit to growth, that would be a much different story for the equity market. So I think the bond market continues to be in the driver's seat, but that yield comparison to stocks as to whether it's inverse or positively correlated is a function of why yields are doing what they're doing. And down on growth expectations deteriorating quite significantly, negative for equities.
Liz Ann, when you think about a higher probability of a recession, what's your expectation for the equity markets? Is this, a garden variety, mild cyclical recession where you may have to go down 20, 25% like an early 1990s, or do you think it's something that could be more ominous than that?
Well, there doesn't appear to be any significant dislocations within the financial system. So that could be something that prevents this thing from getting much worse. But if we were to see a significant tightening in financial conditions, a blowout in credit spreads, then you would call into question then the health and stability of the financial system. There's one pretty consistent determinant of whether a correction turns into a bear market or not, and that is recessions. Corrections that have not been accompanied by a recession at some point in the not too distant future tend to just stay in correction territory. Those that morph into bear markets, it's a function of recession or not. So as you see recession probabilities go up, you're probably going to see bear market probabilities go up.
And we're also seeing that traders are now fully pricing in a Fed rate cut in June. Previously, that was July. I wonder, Liz Ann, how you are thinking about how these tariffs frame the market's reaction to economic data moving forward. Are we going to be back to bad economic news being good news because it gives the Fed an excuse to cut earlier?
I doubt it. I think, and at some point you get to that component or that piece in the cycle where easier monetary policy is sufficient to kind of right the economic ship. But I think it's premature to say that any kind of bad news, particularly on the labor market front, simply because it allows the Fed to ease. I'm not sure a 25 basis point cut in the Fed funds rate sort of cures the ills of what we're likely to see in terms of tariff-related impact. Not to mention the Fed is still in a bit of a pickle because in an environment where the economy really deteriorates, given tariffs, you're probably not going to see that commensurate deterioration on the inflation front, which means they have to make decisions in the context of both sides of their mandate not sending the same message.
How do you think this ultimately settles? If the Federal Reserve can't do it with a 25 basis point cut, will we have to see greater clarity on the trade side, on the fiscal side? I mean, what are you looking for to get a sense that we may be at extreme volatility or markets may be bottoming out?
I think it has to be more clarity or just an improvement to the trade backdrop. Again, I think just a simple shift in the monetary policy reaction function to being biased back in easing mode doesn't seem like that is going to cut it. I think we also have to get through first quarter earnings season and reporting season, because I think it's a fairly easy guess that what companies are going to discuss on their conference calls is any profit margin pressure they see. And what is still a consensus expectation for double-digit earnings growth in 2025, albeit down from where we were at the beginning of the year, is still predicated on very healthy profit margins and not much compression. And I think that is a clear sort of forward-looking trajectory that's now being called into question. So I think we would need to see some stabilization there. And I think we're just at the beginning of the process of any kind of re-rating that's going to happen on the profit margin side.
To what extent does the Fed have the tools to combat any weakness? Like you mentioned, obviously, the wealth effect of the equity market sell-off continuing here, but also any macroeconomic weakness. Does the Fed need fiscal policy to come in a little bit more in line in order to be able to help this economy?
I guess it depends on how you define fiscal policy. One of the frustrations in my mind to a lot of the shorthanding that's done with regard to headlines is that this will all be offset by upcoming tax cuts. We have to remember that what's being discussed here, for the most part, is the extension of 2017's tax cuts, not a whole bunch of new tax cuts, other than on the margin on overtime and Social Security and tips. But that's very different from the backdrop in 2017, when the administration offered the candy first, and that candy was massive tax cuts, which gave a boost to the economy, got the spinach later via tariffs, which were much narrower, much smaller in scope, and didn't have that retaliatory element to it. Now we're clearly getting the spinach this time, and it's much more significant than what we saw. It's not really candy, other than thinking that if those tax cuts are not extended, that would be a massive hit to the economy.
Lizanne, before we let you go, this is one of those moments in markets where it's kind of breaking through the fourth wall, and we're getting messages from friends and family who never watch the market and are freaking out about their 401ks this morning. Just want to get a chance to hear from you. What is your message to those folks who are starting to panic about the health of their retirement accounts moving forward?
Well, panic is not an investing strategy, and we always like to remind people of that. So if the goal is to try to, fully get out and then get back in at some future moment in time, get in and get out are gambling on two moments in time. That's not an investing strategy. So all along, investors should have been mindful of diversification across asset classes. The fact that international has trounced U.S. That was not a big story because everybody just assumed, or a lot of investors assumed, the U.S. is the only game in town. The concentration risk that became really, really prevalent given the dramatic outperformance of the Magnificent Seven, that has completely been turned on its head. So that rebalancing discipline would have aided investors in this kind of backdrop. And unfortunately, you sometimes learn the hard way that those tried and true disciplines around diversification across asset classes, periodic rebalancing, which just forces us to trim where there's been outsized gains. We sometimes learn the hard way that there's a big gap between what we think of as our financial risk tolerance, kind of what's on paper, and then our emotional risk tolerance.
Lizanne, really great response there. Thank you so much, and thanks for breaking all that down for us. Really appreciate it.
My pleasure. Thank you for having me.